Hello there everyone, interesting video today on a recent court case which was handed down in the tax tribunals concerning Lloyds Bank. Going back several years, this court case involves the takeover of Lloyds when it acquired HBOS. So back in the 2008-2009, the banking crisis, Lloyds Bank acquired HBOS. So let's just have a look at the structure and what happened at the time. So, HBOS had a subsidiary in Ireland called Bank of Scotland Ireland, and this company was making a lot of losses. All right. So you get the financial crisis happening. Lloyds bails out HBOS, and it acquires all of this that's going on over here. Right. So what then happens is this. All the assets and the liabilities of this Irish company owned by the Bank of Scotland are transferred up to the Bank of Scotland. So Bank of Scotland Ireland transfers all its assets and liabilities to the Bank of Scotland. Now remember, this is a UK company, this is a Republic of Ireland company. That was done via what's called cross-border merger relief. So there's provisions within the EU. When we're in the EU, you could merge between UK companies and non-UK companies that were also in the EU. So that's what happened here, basically on a tax-favourable merger regime. So there was this cross-border merger, which basically meant that the assets and liabilities of the Irish company moved up to the UK company. And then what happened was, this company with the losses was then what we call group relieved to this subsidiary of Lloyds. So subsidiary of Lloyds called Lloyds Asset Lending, that was making a few quid, that was profitable. So what they did, they claimed group relief. Now group relief is basically saying if there is losses elsewhere in our business group, we'll transfer them to our profitable business to reduce their tax bill. And that's perfectly legit. That's just been around for forever. That's not aggressive tax planning. That's just playing totally by the rules. It's called group relief. Losses over here to set off against profits over there. So again, making use of, at the time, cross-border group relief. So this is an Irish entity making losses, surrendering those losses to a UK company to set off against the UK company's profits. All right, all very well and good. So, here's the thing. Tribunal got hold of this. After HMRC had challenged it, HMRC said, look, the main reason for doing all of this was to get a tax advantage. So, let's just backtrack. What do we mean by a tax advantage? There are several things in the UK tax code where you clearly will do something to get a tax advantage. Like, for example, invest in venture capital trusts. Now, VCTs can reduce your income tax bill, and the government brought the rules in to encourage people to invest in these riskier assets, and we're going to give them a tax break. There's nothing in the tax code around VCTs that says you cannot do this if you're doing it for a tax purpose. Now, yes, any financial advisor worth their salt would say, come on, you've got to do it for a commercial purpose first, and then if there's a tax break thereafter, terrific. But, there are a lot of people who will do it just to reduce their tax. And that's fine. There's nothing in the tax world that says you can't do that. However, there are other things in the tax world that pretty much say you can't do that. What do I mean is that certain bits of legislation say that you cannot do this if the main driver for doing it, the main reason for doing it, was that you're going to get a tax break at the end. And it's enshrined in all sorts of areas of the UK tax code. So you have to prove that the main reason you did something, there was a commercial justification. Oh, and as a side, as an add-on, yes, there might have been some tax relief thereon. But the main reason why you went into it was not to save tax. And this arrangement falls in one of those camps. Now, what happened is, HMRC said, look, Lloyds Bank, you only acquired this Bank of Scotland Irish subsidiary because you wanted to get your hands on these valuable losses so that you could move them over to one of your profitable subsidiaries over here, this leasing business. And Lloyds Group said, hang on a minute, look, we invested in Ireland, and then we took a decision a couple of years later to cut our losses and get out of Ireland. It wasn't making any money. So then we quit Ireland and we liquidated this company after having transferred the assets up here to the UK company. And the tribunal said, okay, look, yes, you did have a commercial rationale for pulling out of the Irish market because the business had tanked, it was going nowhere. That's a commercial rationale. But before that, fundamentally, the reason you entered into all of this was to get your hands on these valuable losses that were in the Irish company, that you did all this jiggery-pokery to get it in the UK company to set off against the profits of your Lloyds subsidiary, Lloyds Asset Leasing. And the tribunal sided recently with HMRC to say that that group relief, i.e. transfer of losses from there to there, doesn't work in this instance, because the main motive for doing all of this was to save tax. It wasn't secondary to the commercial rationale. So interesting court case there. And we will see if there's going to be appeals on this, if it's going to go up through the judiciary in the UK, see what happens. But I just thought I'd share that with you. Caught my attention when I was reading the tax press this week. Always interesting when it's a household name, the firms that we all can relate to. So Lloyds Bank losing a tax case in the UK tax courts. If you like this video, please do subscribe. And as always, I'll see you soon.